Hey guys, Chris from Adaptation here, and this is video number 3 in my balance sheet series. If you want to see the other videos on this playlist, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. So in this video, I'm going to be showing you how to prepare the non-current assets section in the statement of financial position. And I'm also not going to be repeating the phrase statement of financial position. I'm just going to say balance sheet. So I hope you're okay with that. So in my previous video, I explained how to deal with the current assets and current liabilities sections of the balance sheet. And we also distinguish between what current is and what non-current is. So current assets are assets that we expect to use up or convert to cash within a year or less. So we know stuff like inventory or stock, accounts receivable or debtors. We talked about accrued revenue, prepaid expenses, cash at bank, and cash in hand. Now, there are a few others which I didn't get into, but we will see in some future videos. Non-current assets are those assets that we expect to last for longer than 1 year. We expect them to last for multiple years. Some examples are equipment, furniture and fittings, fixtures and fittings, motor vehicles, plant, property and equipment, and many, many other things. And for those of you who may be a bit more knowledgeable about POA, we know that associated with non-current assets, or maybe you call them fixed assets, we have the ever popular depreciation. Now, unlike the topics that I talked about in my previous video, the accrued and prepaid revenues and expenses and the provision for bad debts, I unfortunately, at the point in time of this recording, do not have a video series explaining the provision for depreciation. You might find 1 or 2 videos mentioning it when I did some past paper solutions early in 2021, but in terms of like an actual tutorial as to how to deal with it, I don't have one yet, but I'm going to be working on that just for you guys. That being said, I will briefly explain what depreciation is and how it relates to what we're going to be doing in this video. But I won't be getting into all of the nitty-gritty details and that kind of stuff. I'll save that for the major video. And as a matter of fact, let's get into talking about that now. Okay, so what is depreciation? Put very simply, depreciation is the loss in value of an asset over time. Why do assets lose value, I hear you ask? Well, simple. I'll give you a few reasons, but there are more which I would encourage you to check out online or in your textbooks. The first and primary cause of depreciation is use of the asset. So the asset wears out due to use, right? The next reason is obsolescence. So you guys know you have your phones, your tablets, your laptops, and then a newer model comes out that does everything that your model does, but does it better. Right, so the older model, let's say somebody had some older models that you had in boxes, unsold. You can't sell them for the price that they were back when they bought them, especially if new models are out. So they've lost value relative to the newer models. Third reason is a fancy word here, the efflusion of time or the passage of time. So as we know, time comes for us all in the end, and as humans, and even as machines or assets, if you just put them down and don't do anything with them, they could seize up on that kind of stuff and then hence lose value or just basically be destroyed or disintegrate. So as time passes, things lose value. And the last reason I'll give you very briefly again is something called depletion. Now this pertains mainly to biological assets such as like fruit trees or crops and that kind of stuff, or geological assets such as oil fields, quarries, fields of natural gas, and these things. Because when you extract those resources, especially if they're non-renewable, you leave less of the resource in whatever plot of land or however they quantify it. So there's less value left in the land or the property. So it means that that item has lost value because we've literally and physically taken out stuff, right? So those are the 4 reasons I'm going to give you. And again, I would encourage you to do your own research as to other reasons for depreciation. Okay, so as I said, I'm not going to be delving too much more into the theory behind depreciation and all that nice stuff like the matching principle, although I may mention that in this video. I want to get to the stuff that we are doing today, all right, which is the balance sheet and specifically the non-current asset section. So just so you know, there are 2 methods of depreciation that you have to know for the purposes of CSEC. There's the straight line method and the reducing balance method. Now again, when I do my proper tutorials on depreciation and on those methods, I'll go into some more detail as to how to do them quote unquote properly. I will be showing you guys how to do the calculations here, but just know more details are coming in future videos, right? And with that said, let's get into today's content. Okay, so in this example, we are going to take a look at how to deal with the straight line method of depreciation. Now, this method charges the same amount for depreciation every year. And again, when I do the video teaching this particular method, I'll go into some more details. Right now, I'm giving you the shortened version that deals specifically with how we treat with it in the balance sheet. So we have here, you are given the following extract of the trial balance of CU later as at Jan 31st, 2017. So we have furniture and fittings and equipment, and as you can see here, it says at cost. And those items are in the debit column. So just in case you didn't know, assets have debit balances, and when you do up a trial balance, the balance in the assets account will usually be in the debit column. Now, just below that, you're seeing provision for depreciation, but you're not seeing anything here. But below the provision for depreciation, you're seeing indented furniture and fittings and equipment, and you're seeing balances off to the right under the credit column. So these balances here are the balances for the provision for depreciation on the furniture and fittings and the equipment. So according to how much room you have on the question paper, you will see this phrase in the same line with the asset, which simply means that that will be the provision for depreciation on that specific asset. Now, you may be wondering, why is the provision for depreciation in the credit column? Isn't depreciation an expense? Right, so the answer is yes, and again, I'll briefly mention here, depreciation is an expense, and you will see it in the income statement, but there are two ways to record it in terms of double entry. One involves the use of a depreciation expense account, which is not the way that you are required to know for CSEC, right? Strangely enough, for CAPE accounting, you are required to know it that way. So I think there's a bit of a disconnect, but we'll get back to that. Okay, so the reason that there is a credit balance for the provision for depreciation for any non-current asset is because just like the provision for bad debts, which is a contra asset, the function of the provision for depreciation is to show how much value was lost out of the asset. So the provision for bad debts is an estimate of the value of debts that we expect to go bad or become uncollectible. And what do we do with the provision for bad debts in the balance sheet? We subtract it from the debtor's balance, hence reducing the net receivables value that we expect to receive. So the provision for bad debts reduces the value of debtors in the balance sheet, and the provision for depreciation reduces the value, not the cost. The provision for depreciation reduces the value, the book value of the non-current asset in the balance sheet. And since assets have debit balances, we need credit balances to reduce the debit or to counterbalance. That's why the provision for depreciation items have credit balances, and the assets, the cost of the assets are shown as debit balances, okay? Now, the additional information says, see you later depreciates all non-current assets using the straight line method. Furniture is 10% per annum, equipment is 20% per annum. Now, what we're simply going to do here is we are going to take those percentages, 10 for furniture, 20 for equipment, and we are simply going to multiply them by the cost of the asset shown here in the trial balance. That's all we're going to do to calculate the current year's depreciation, right? Now, there are three different depreciation figures, so you need to know what's going on with them. The first one, as we just saw, is the provision for depreciation. Now, that figure there in the trial balance, that is not the current year's depreciation. That is not going to go in the balance sheet. That represents the previous year's depreciation on the assets. What we need to do is find the current year's depreciation expense, the current year's increase in the provision, add it to these figures here, and that figure will give us the balance sheet figure. So let me recap that. These figures are the depreciation figures from the previous years. We need to find the current year's depreciation to add on to it to get the new balance for the provision for depreciation that goes in the balance sheet. So if we look on the right-hand side, you'll see a little note to that extent. The trial balance figure plus the depreciation expense figure is the figure that goes in the balance sheet in respect of depreciation. Right. So I know sometimes explaining things with words, I'm not sure how else to explain it. Explaining things could be a bit confusing. We need to see it, how it works and the workings for it and really make sense. So let's do that now. So F&F stands for furniture and fittings, equip stands for equipment. I'm abbreviating because when I created the handout, I wanted the information to be on the left and the space for the working on the right, as you guys see it here, and I didn't want to put the font too small, right? So please don't come at me for my abbreviations, all right? Okay, so as I said, we're going to take the cost of the asset. So the furniture and fittings cost is 50, and its provision percentage is 10%. So we're going to take $50,000 and multiply by the depreciation rate, and that's going to give us 5,000. Now that is the depreciation expense figure for the income statement for furniture and fittings. Okay? What do we need to do? We have to find the balance sheet figure. How do we find that? We take the trial balance figure and add it to the depreciation expense figure. So we just found the depreciation expense figure for furniture and fittings, and we need the trial balance depreciation. So we're going to add those two together, right? So 5,000 plus 10 is 15, and that is your balance sheet figure, right? Let's repeat that for the equipment. What we need is the cost of the asset and to multiply it by the depreciation percentage. The cost of the asset is 40,000. Its depreciation rate is 20% per annum. We are using the straight line method, so we simply multiply those two figures together. And we're going to get 80,000, right? 40,000, sorry, not 80, 8,000. 40,000 by 20% is 8,000. Now, that's the depreciation expense figure. That's the income statement figure. What are we looking for? A balance sheet figure. How do we get that? Depreciation expense figure, the expense figure, plus the trial balance figure gives us the balance sheet figure. What's the trial balance figure for the provision for depreciation for equipment? 16? Right, so we're going to take 8, add 16, and we're going to get 24. And these figures here, those are the balance sheet figures. So these figures are going to go in our balance sheet extract, which I'm going to show you now. So we have our balance sheet extract. So head up your extract properly. See you later. Statement of financial position extract as at Jan 31st, 2017. Now, we need to put some headings here. So we are in the non-current assets section of the balance sheet. Right? Let's put some dollar signs there. Okay. So we have two assets to deal with, furniture and fittings and the equipment. Now, please notice my headings for my columns. In the previous video, I did not have headings for my columns apart from the dollar sign. These headings apply to the non-current assets section because there is an accounting concept called the historical cost principle. It says that non-current assets must be shown at their depreciated historical cost in the financial statements. What is historical cost? It simply means the price that you paid for the asset when you bought it. The price paid back in history. Although we think history is centuries ago. No, that minute, that second I went there, that's history now, right? So when you buy the asset, the amount of money you pay for it, that's the historical cost. So the historical cost concept says, hey, you need to show that cost and you need to show what the value is after the depreciation has been charged on the asset. So we need the cost of the asset. We need to show the depreciation of the asset. Now, just a little note here. Normally, I would put either this heading as provision for depreciation or accumulated depreciation. Accumulate means to build up over time. And of course, the figure in that column would represent the total amount of depreciation charged on the asset over time. But again, because of space considerations, I didn't want to put that to make things appear more than one line. So again, pardon me. And NBV stands for net book value. We've met the word net before. Net means after all deductions have been made. So this is the book value after all deductions have been made. And I hear someone, what is book value? I don't know what book value is. It is literally the value of the asset in the accounting books, the accounting records. It's called the book value, the value of the asset on the books. That's it. Don't overthink it. That's just what it is. Okay? Now, how do we get net book value? Cost minus depreciation is net book value. So let's take a look at the furniture and fittings. So we are seeing that the cost is 50,000 and the balance sheet figure up here that we're seeing is 15,000. And we're going to subtract 15 from 50 and get 35. Now, yes, brackets are optional. I was trained to use brackets as a visual cue to subtract. I do agree that they are not necessary. They do clutter up the visual space even a little bit, and that's not something you want. If you feel comfortable using the brackets, feel free to use them. If you don't like the brackets, don't use them. Not a problem, no judgment. Now let's repeat for the equipment. Equipment, the cost of the equipment I'm seeing here is 40,000, so we're going to put that here. Equipment 40,000, nice. What is the depreciation on the equipment for the balance sheet? $24,000, so we're going to put that there. And 40 minus 24, cost minus the depreciation, gives us $16,000, which is the net book value of the equipment. Now, what we want to do is we want to add the columns going down. 50 and 40 is 90, 15 and 24 is 39, 35 and 16 is 51. And if you go across, 90 minus 39 is 51. So you have a bit of a cross check. Going across must be the same as going down for the last column. Okay. All right. So what I want to do now is I want to give you guys a question just like this to try. Okay, so what I've done is I've put the question on the left-hand side and I've left the example up on the right-hand side should you need it. So I'd invite you now to pause the video, try the question, and then unpause it to check your answer. Okay, how did it go? Did you look at the example and follow along? Did you try it on your own? No judgment either way. You do you, all right? Okay, so practice question 1. You are given the following extract of the trial balance of Seminole as at February 28th, 2017. Okay, so fixtures at cost, vehicles at cost, and the associated provision for depreciation on each asset. So additional information. Seminole depreciates all non-current assets using the straight line method. Fixtures is depreciated at a rate of 20% per annum, whereas vehicles is depreciated at a rate of 25% per annum. So okay, what do we need to do? We need to figure out the balance sheet figure. The balance sheet figure for provision for depreciation for each of these items. So as it says across here in the example, we need to take the trial balance figure and add it to the depreciation expense figure, the income statement figure for depreciation for the current year. So let's take a look at those calculations. Okay, so let's start with the depreciation calculations for the fixtures. So as we can see across here, the fixtures, the cost of the fixtures is $25,000, the depreciation rate is 20%. So we're going to take that $25,000 and multiply by 20%, and that's going to give us $5,000. And we need to add that to the previously existing depreciation, the trial balance depreciation, and that's going to give us our balance sheet figure. 5 plus 10 is 15. Now let's repeat for the vehicles. The cost of the vehicles is $72,000. The depreciation rate is 25% per annum. So we're going to multiply 72,000 by 25%, which is going to give us 18,000. And we're going to need to add that to the previous depreciation on the asset, which is also 18,000. And 18 plus 18 is 36. Okay, so now we're going to do the balance sheet extract, right? The extract of the statement of financial position. So we have two assets. We have the fixtures and the vehicles. Let's start with the fixtures. So the cost, as we know from before, is 25,000. The depreciation figure is 15. And we have to subtract that from the cost to get the net book value. And 25 minus 15 is 10. Okay, let's deal with the vehicles now. So the cost of the vehicles is 72,000. So let's put that in. So 72,000 there. And the depreciation, as we just calculated, is 36,000. So we're going to subtract that and get the net book value, which is also 36. And let's fill in the bottom row here. So 25 and 72 is 97. 15 and 36 is 51. 97 minus 51 is 46. And 10 plus 36 is 46. Okay, so now let's take a look at the reducing balance method. Okay, so this is example 2 showing the reducing balance method of depreciation. So we are given the following extract of the trial balance of Now You See Me as at 31st March 2017. So we have two assets, machinery and vehicles at cost. Again, the cost of the assets is in the debit column because assets have debit balances. The provision for depreciation on the assets, those values will be in the credit column because, again, these provisions are contra assets. Their function and purpose is to reduce the value of assets in a balance sheet. If assets have debit balances, to reduce them, we need counterbalancing credit balances. Okay. Additional information. Now You See Me depreciates all non-current assets using the reducing balance method. So we have the machinery being depreciated at 10% per annum, and the vehicles being depreciated at 25% per annum. Now, again, before I get into the calculation, please remember, I have not done this topic by itself. When I do, I will explain in more detail how to treat with these things, but I am going to give you enough information so that you can do the balance sheet, right? You can treat with depreciation in the balance sheet. Now, the major, and listen to this carefully, please, the major difference between the calculation for depreciation under the reducing balance method relative to the straight line method is, under the straight line method, we multiply the percentage for depreciation by the cost. For the reducing balance method, we multiply the depreciation percentage by the net book value of the asset. I'll repeat that because I know some of you all blanked out, right? For the reducing balance method, to calculate the depreciation expense, we multiply the depreciation rate, the percentage, by the net book value of the asset. Now, we saw net book value in the previous example, and you all should be familiar with it by now, I hope. If not, well, hopefully you're familiar with it from this video. Net book value is the cost of the asset minus the existing provision for depreciation. So let's go to the calculation table and take a look at that now, shall we? So you should be seeing some stuff highlighted in orange up here, right? So under the reducing balance method, depreciation expense is the net book value multiplied by the depreciation rate. And we know already net book value is the cost minus, well, I have trial balance depreciation here, but that is specifically for the purpose of the calculation, okay? Let's start with the machinery. So to calculate the depreciation for the machinery under the reducing balance method, we need to multiply the net book value of the machinery by the depreciation rate. So let's start with net book value, shall we? How do we find net book value? That's this line here in orange. Net book value is the cost of the asset minus the existing provision. So that's 10,000 minus the 1,900. So let's populate that and subtract. So 10,000 minus the 1,900 is 8,100. We then multiply that by the depreciation rate, which we could see is 10%. So 8,100 by 10% is $810. Now we're not done. Remember what we did before in the previous set of examples? We have to add that back to the trial balance depreciation. So that's the income statement figure. We have to add that to the trial balance figure to get the balance sheet figure. So the existing provision for depreciation is 19. We actually have it up here already. So we have to add that back here, and that's going to give us a total now of 2710. So that figure is the balance sheet figure for depreciation for the machinery. Again, to get it, you had to take the depreciation rate and multiply it by the net book value. To get net book value, that's cost minus the depreciation, which they gave us on the left side. So cost minus depreciation is net book value. Multiply that by the depreciation rate, and that'll give us the depreciation expense. That's the income statement figure. To get the balance sheet figure, we have to add that, the current year's depreciation, to all of the previous year's depreciation, what I call the trial balance depreciation. And that will give us the depreciation figure for the balance sheet. Now let's repeat for the vehicles. So again, vehicles, the cost is 64, existing depreciation is 28. So we're going to take 64 and minus 28, that's going to give us 36. We are going to multiply that, which is the net book value of the vehicles, by the depreciation rate for the vehicles, which in this case is 25%. And 36 by 25% as a quarter is going to give us 9,000. So that's the depreciation expense for the current year. That goes in the income statement. What we want is the balance sheet figure. How do we get that? Income statement figure plus trial balance figure. So the trial balance figure for the provision for depreciation for the vehicles is 28,000. When we add 9 to 28, we're going to get 37,000. So these figures here, those are our balance sheet figures. So now let's take a look at the balance sheet extract. Right, so you're seeing it's properly headed up already. Now you see me statement of financial position extract as at March 31st, 2017. So the heading for your section, non-current assets, and the headings for your columns. Okay, so what two assets do we have? We have machinery and vehicles. So we need the cost. So again, the cost was 10,000 and the depreciation figure for machinery is 2,710. So let's populate everything. 10,000 minus 2,710 is 7,290. Let's repeat for vehicles. For vehicles, the cost is 64 and the balance sheet figure, as you can see here, is the 37,000. So we're going to plug everything in. 64 minus 37 is 27. And now this row down here, again, that's simply the total of each column going down. So 10 and 64 is 74, 27, 10 and 37,000 is 39,710, and 7,290 plus 27 is 34,290. Okay, so what I want to do now is I want to give you guys a question just like this to try. Okay, so again, I've put the question information up on the left-hand side, and I've left the example that we just did on the right-hand side. So take a read of the question. You can look at the example. Again, you're not under exam conditions. You're here to learn. Try the questions and unpause the video. Well, sorry, I should have said pause the video, try the question, and unpause to see the solution. Okay, how did it go? It's a little shaky. That's okay. Depreciation usually gives people a little bit of trouble, but just like with anything in life, the more you practice properly is the better you will get at it. And again, I know I haven't said it before, but if you have any questions at all, please message me in the comment section below, right? I'm here to help. Once I have time, I'll respond, okay? All right, so let's take a read of the questions information. So you are given the following extract of the trial balance of now you don't. So we have equipment and motor van, as the cost of the assets there, and we have equipment and motor van, the provision for depreciation shown down there. Additional information. Now you don't depreciate all non-current assets using the reducing balance method. We have equipment 20% per annum, motor van 40% per annum. So again, we're using the reducing balance method of depreciation, which we know requires us to multiply the depreciation rate by the net book value of the assets. So let's take a look at the workings and see what happens. Okay, so let's start with the equipment. So we know we are going to need the net book value of the equipment, which requires the cost of the equipment and the existing provision for depreciation. So that was 12,005 minus 4,005 is 8,000. Next, we're going to multiply those figures by the that figure by the depreciation rate of 20%, which is going to give us 1,600. And finally, to find the balance sheet figure, we're going to need to add that figure to the existing provision for depreciation, 4,500 from the trial balance. And 1,600 plus 4,500 is 6,100. Let's repeat for the motor van. So for motor van, we need cost minus the existing depreciation to give us net book value. The cost of the motor van is 40,000, the existing depreciation is 16, and 40 minus 16 should be 24,000. Nicely done. Now we're going to multiply that, which is the net book value, by the depreciation rate, which is 40%. And I think that's going to give us 9,600. Yeah, there we go. Now that is the income statement figure. That's the depreciation expense for the current year. What do we need? The balance sheet figure. How do we get it? We take the income statement figure and add it to the trial balance figure. So the trial balance figure, as you can see above, is 16,000. 9,600 plus 16,000 is 25,600. So now we have the information that we need in order to populate the balance sheet extract. So let's take a look at that. Okay, so it's already properly headed up. Now you don't statement of financial position extract as at April 30th. So everything's properly headed up. The subsection, the section heading, the column headings, etc. So we have two assets that we're dealing with, equipment and motor van. So the cost of the equipment, right, is 12,005. The depreciation that we need is 6,100. So we're going to do 12,005 minus 6,100, giving us 6,400. For the motor van, the cost is 40,000. The existing depreciation is, the depreciation from above is 25,600. So we're going to subtract that and get 14,400. And then we're going to add the columns going down. 12,500 and 40 is 52,500. 6,100 and 25,600 is 31,700. And 6,400 plus 14,400 is 28,000. And if you subtract going across here, you're also going to get 20,800 in this last cell here. Okay, all right. So I want to do one more example where we use both methods, and I'm going to give you guys one question to try using both methods as well. Okay, so in this example, we're going to take a look at how to use both methods in the same question. Okay, so it says you are given the following extract of the trial balance of You Can See Me. All right, so we have two non-current assets, fixtures and machinery, 50,000 and 400,000 respectively. Then we have the provision for depreciation associated with those non-current assets. Now notice again, the provision figures are in the credit column, whereas the cost of the assets, right, those are in the debit column. Why? The provision for depreciation is a contra asset. Its function, its role and function is to reduce the value of the asset shown in the balance sheet, right? And if assets have debit balances, to reduce those, we need counterbalancing credit balances. Now let's take a look at the depreciation information. So for the fixtures, they're being depreciated at a rate of 20% using the straight line method. So we know in that case, we're just going to take that 20% and multiply it by this 50,000. There's nothing else that needs to be done to calculate the depreciation expense. All right. For the machinery, however, that's being depreciated at a rate of 25% using the reducing balance method. What did we see in the previous example and question? To calculate the depreciation expense for the reducing balance method, we have to multiply the rate by the net book value of the asset. The net book value is the cost of the asset minus any depreciation on it already charged. So let's take one thing at a time. Let's take the fixtures. We're going to take that 20% and multiply by the 50,000, right? So I'm going to start here actually. So the cost is 50,000. That's multiplied by the 20%. That gives us 10,000. Don't worry about net book value. That has to do with the machinery. So just ignore it for now. Now, this 10,000 is the current year's depreciation expense, the income statement figure. What do we need? The balance sheet figure. How do we get it? We add this 10,000 to the previous depreciation as per the trial balance, which is 20,000. And 10 and 20 will give us 30,000. Okay, now for the machinery depreciation. So again, machinery is being depreciated at a rate of 25% using the reducing balance method. How do we calculate depreciation on the reducing balance method? We multiply the rate by the net book value of the asset. What is net book value? The cost of the asset minus the depreciation already charged. So that's going to give us 225. And what do we do with that 225? Well, we have to multiply that by the 25%. That's the depreciation rate. That's going to give us 56,250. Now, that is the depreciation expense for the current year. That's the income statement figure. What do we need? The balance sheet figure. How do we get it? We add the income statement figure to the trial balance figure of 175. So we're going to add those two together, and that's going to give us 231,250. Right. So now we have the depreciation figures that we need to populate the balance sheet. Let's take a look at that. Right, so you're seeing it headed up properly here. You can see me, statement of financial position extract as at the appropriate date. And we are seeing that the headings are already populated there. Good. We have our two assets, fixtures and machinery. So for fixtures, we need the cost of the asset, which is 50,000, minus the depreciation figure for the balance sheet, which is 30,000. And that's going to give us the net book value, which is 20,000. Again, we need to show it this way because of the historical cost concept, which says that assets must be shown at their depreciated historical cost. In other words, the historical cost, again, is just the cost of the asset, and we have to show how much depreciation is charged and the value after said depreciation is charged. Long story short. Let's deal with the machinery now. So the machinery's cost is 400,000. The depreciation associated with the machinery is 231,250. So we are simply going to subtract going across and get 168,750. The last row will be populated simply by adding down. So 50 and 400 is 450. This is 261,250. And when you add down, you get 188,750. And if you subtract going across, you're also supposed to get 188,750. Okay, right. So I want to give you guys one last question to try. Okay, so this is practice question 3. You are given the following extract of the trial balance of Just Leave Me Alone, June 30th, 2017. Two assets, equipment and vehicles is the cost. The associated provision for depreciation is given to us as well. So depreciation, equipment, 10% straight line method, vehicles, 20% reducing balance method. So I've left the example up on the right-hand side, the information is up on the left-hand side. You know what to do by now. Okay, shall we correct? Let's go. Okay, so let's deal with the equipment first. So equipment is depreciated straight line method. So we're just going to take the 80 and multiply by the 10%. That's going to give us 8,000. Which we will have to add to the existing depreciation of 24,000, and that will give us a new depreciation of 32,000, balance sheet figure. Vehicles. Vehicles is depreciated using 20% reducing balance method. So we need to multiply that 20% by the net book value. How do we find net book value? Cost of the asset minus the existing depreciation. So we're going to see 625 minus 225, which is going to give us 400,000. And we have to multiply that by 20%, which is going to give us, I think, 80,000. Nice. And what do? Are we done? No. We have to add that to the existing depreciation on the vehicles, which is 225. And that's going to give us a new total of 305, right? So these figures here, sorry, one second. All right. These figures here have to be put in the balance sheet. So let's take a look at the balance sheet extract now. Right, so did you head it up properly? Just Leave Me Alone, statement of financial position, extract as at 30th June 2017. Don't forget, head up your columns, please. Right, so we have two assets. Right, now of course it's quite possible to have more, but I'm just using two because, again, space was limited and I don't want to do too many things at the same time. All right, so equipment. The cost of the equipment is 80,000. The depreciation we need is 32. So we're going to do 80 right? We're going to do 80 minus 32, which is 48,000. Right. Now let's take a look, right, at the vehicles. The cost of the vehicles is 625. The associated depreciation is 305. So we simply have to subtract and get 320. And now we add going down for each column to get a total. So 48 and 320 is 368. And if you subtract going across, that's supposed to give you 368 as well. So I hope that was good. Again, if you have any questions, please feel free to put them in the comment section below and I'll make sure and get back to you. Okay, ladies and gents, there you have it. That is how you treat with depreciation, the provision for depreciation in the balance sheet, the statement of financial position, using two methods, the straight line method and the reducing balance method. With all that said, guys, thank you so much for watching. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe, please. Check out my website for some free pay rate handouts. If you guys want this one there, let me know. I'll see if I can put it up. Some of them I can, some of them I can't, but I'll see. Anyway, guys, thanks again for watching. I'll see you next time. Bye.